California's housing market isn't slowing down, it's overflowing. In 2025, policy gridlock and zoning wars from the last decade have produced a flood of single-family homes for sale with inventory surging more than 25% on the mid to high end. Buyers now command unprecedented bargaining power, but every new listing is a trap for sellers. The financial penalty of moving is so severe that millions are stuck watching their homes sit for months. The official narrative promises more options, yet it's today's sellers who are paying the price. Why did California bet everything on a supply surge, only to strand those who need to move most? The answer starts where the crisis truly began. In Elk Grove, the city council chambers filled with anxious homeowners and local activists on a summer night in 2019. Voices rose, some demanding new apartments to ease rents, others warning that more density would ruin the neighborhood's character. By the end of the evening, the outcome was clear. For council members voted yes, one no. The urgency ordinance passed on yeast, an immediate halt on new market rate apartment applications across key commercial corridors. The stated reason: time to study zoning, design standards, and affordable housing rules. But for many, the moratorium was a victory against change. The restriction excluded affordable and senior housing, but the message was unmistakable. Elk Grove would slow the pace of new apartments, at least for now. This pattern played out in suburbs across California. Many Roseville and parts of Orange County all saw similar meetings. Packed rooms, heated debates, and councils bowing to pressure from residents wary of apartments or worried about parking in schools. While state laws like SB 35 and SB 330 pressed for more housing, local governments found ways to delay or cap multifamily projects, often through temporary moratoria or by slow walking permits. Between 2015 and 2020, these local moves quietly shaped the future housing mix. Most new construction approvals favored single-family homes, not apartments or townhomes. Homeowners, preservation groups, and neighborhood coalitions used public comment periods and legal appeals to push back against denser development. The result: in city after city, the supply of new homes tilted heavily toward detached houses, even as demand for rentals and affordable options kept climbing. By the time the moratorium in Elk Grove expired, the effects were baked in. Developers had shifted focus, wary of risking capital on projects that might stall in City Hall. Housing advocates warned that these decisions would haunt the market for years, locking in a shortage of options for renters and first-time buyers. As the years passed, the cumulative effect of local resistance became visible in the numbers. Most of what got built was high-end, single-family, and out of reach for many. The groundwork was laid for the inventory surge seen in 2025, and for a flood of listings that offered more of the same, but not what many Californians actually needed. Regional builders saw the writing on the wall as city councils clamped down on apartments. Permitting delays and public resistance made multifamily projects a gamble. So, developers shifted their bets. Instead of fighting uphill battles for dense, affordable units, they poured resources into detached homes, especially in the outer suburbs and exurban fringes. Permit data from 2017 to 2022 tells the story. Single-family approvals climbed steadily, while new apartment permits flatlined or fell in many cities. In Roseville and many, local planning records show that over 70% of new housing approvals in these years were for single-family homes, most priced well above the regional median. National builders like Leonard and Dr. Horton zeroed in on higher-end products, aiming for buyers with strong credit and big down payments. The math favored larger lots and 4-bedroom floor plans, not affordable starter homes. Internal builder reports from 2021 highlight a conscious pivot targeting move-up buyers and dual-income households. Even as entry-level demand went unmet, custom home specialists and regional outfits followed suit, rolling out new subdivisions with price tags north of $700,000 in places like Elk Grove in the Central Valley. Local agents recall model home openings that drew long lines, but mostly from families already priced out of coastal markets. By 2024, the composition of new listings was set. Detached homes dominated the inventory surge, with mid to high-tier properties making up the bulk of what hit the market. Builders facing softening demands started offering incentives, rate buydowns, free appliances, even landscaping credits to move unsold homes. Yet, the supply pipeline remained stubbornly skewed. Affordable options lagged far behind, and the glut of upscale single-family homes flooded MLS feeds from Sacramento to Riverside. The result? More choices for buyers willing to spend, but a growing mismatch for those hoping for a starter home or a reasonably priced rental. By early 2025, the math for California home buyers had changed. Mortgage rates hovered at 6.8% to 8% for a 30-year fixed, nearly twice the average from just a few years prior. For many, that extra 2 or 3 percentage points wasn't just a minor inconvenience. It was the difference between qualifying for a home and sitting on the sidelines. Sales volume told the story. Transactions statewide fell 20% below pre-pandemic levels, with some metro areas like Los Angeles and the Inland Empire seeing even steeper drops. Open houses, once crowded affairs, now drew smaller crowds. Agents fielded questions about monthly payments, not bidding wars. Sellers watched as listings piled up on the MLS. Homes that might have vanished in days during the 2021 frenzy now sat for weeks, then months. Price growth slowed to a crawl, with the statewide median rising just 1.3% year over year, a sharp contrast to the double-digit surges of the recent boom. In some zip codes, especially at the higher end, prices started slipping month over month as inventory built. Buyers, sensing leverage, waited for further reductions or pressed for concessions. The patience was new, and it frustrated anyone hoping for a quick sale. Economists pointed to the rate environment as the key break. With affordability stretched thin, even a modest dip in rates could spark renewed demand. But until then, the market moved at a crawl. The flood of homes on the market wasn't translating into a rush of deals. Instead, it exposed just how sensitive California's housing machine had become to the cost of borrowing. Buyers in California now face a landscape few would have predicted just a couple of years ago. MLS feeds in Los Angeles, San Diego, and the Inland Empire scroll longer than they have since 2019. Active listings are up 25% or more across most major metros. In May 2025 alone, 73,000 homes sat on the market statewide, more than double the count from 2 years prior. The effect is immediate. Showings stretch out, open houses run quiet, and buyers, once desperate, now set the pace. Negotiation tables have flipped. Instead of waiving inspections or outbidding rivals, buyers are asking for closing cost credits, new appliances, or even cash back at closing. A 3-bedroom in Riverside that would have sparked a bidding war in 2021 now lingers for months, with the listing agent fielding requests for landscaping upgrades or a year of HOA dues paid up front. Sellers anxious to stand out agree to rate buydowns, sometimes offering to cover points to drop a buyer's mortgage rate by a full percentage point for the first 3 years. In Orange County, agents report buyers walking away from deals over minor inspection issues, confident another home will be waiting next week. Days on market have stretched past 4 months on average, and in higher price brackets, some listings last over 180 days without an offer. The longer a home sits, the more leverage shifts. Buyers push for repairs, demand furniture credits, or insist on appraisal contingencies that would have been laughed off during the boom. The new playbook favors patience and hardball tactics. For those with the means to buy, the flood of inventory isn't just a statistic. It's a chance to negotiate terms that would have been unthinkable in the frenzied market of just a few years ago. January in Riverside brought a sense of possibility for the Tran family. They had bought their 3-bedroom home for $555,000 in 2021, locking in a 6.9% fixed mortgage, higher than their neighbors who bought during the pandemic, but manageable at the time. When their youngest started kindergarten, they decided to list the house for $599,000, hoping to pocket enough to move closer to extended family. Their agent, optimistic at first, scheduled back-to-back open houses and promised that the right buyer would surface soon. Weeks passed with only a handful of showings. Each weekend, the family deep cleaned, packed up the kids, and waited for feedback that rarely came. By early March, reality set in. The flood of similar listings in their price range meant competition was everywhere. Buyers, no longer in a rush, toured without urgency and left without making offers. The trans agent suggested a price cut. After 90 days, they dropped the listing to $579,000, swallowing the first hit to their plans. Still, the phone stayed quiet. The strain crept in slowly. Their mortgage payment, just under $3,700 a month, left little room for extra expenses. With no sale in sight, the family started cutting back, canceling a spring break trip, pausing contributions to their emergency fund. The agent's tone shifted, too. She pointed out that nearby builders were offering buyers rate buydowns and free upgrades, making resale homes like theirs harder to move. The Trans spent hundreds on paint touch-ups and new mulch for the front yard, hoping to stand out. But as spring turned to summer, the only movement was downward. The listing lingered and optimism gave way to anxiety. Each passing week made the prospect of carrying 2 mortgages feel less like a risk and more like a threat. By July, the Tran family's listing had crossed the 180-day mark. The house sat unchanged, each week bringing a new reminder of the market's indifference. Their agents' emails grew shorter. A letter from the lender arrived, warning that a vacant property could trigger a reassessment of their mortgage terms. The threat wasn't foreclosure, but the message was clear. Extended time on the market carried risks beyond just disappointment. A page from the family's diary dated July 27 captured the mood. Kids ask if we're still moving. Hard to answer. We're worried about double payments in the fall. Talked about renting instead. But even that feels uncertain. The numbers on paper told one story. $3,700 due each month. $579,000 now the asking price. And still no offers. But the real cost was measured in sleepless nights and tense conversations after dinner. Each price cut felt like a defeat. Every showing that ended without feedback chipped away at their confidence. By late August, the family debated pulling the listing entirely. Their agent mentioned other clients doing the same, unable to stomach further losses or the prospect of carrying 2 homes. Builders nearby continued to advertise incentives, making resale homes like theirs looked less appealing. The Tran family weighed the idea of renting out their property, hoping to cover the mortgage while waiting for the market to recover. Uncertainty became the new normal, with every option carrying its own risks. The emotional toll was no longer just background noise. It defined daily life as the promise of a clean sale faded into a cycle of worry and waiting. National builders turned to a different playbook. As the market cooled, instead of cutting headline prices, they packed their sales brochures with offers that never show up on the MLS. Mortgage rate buydowns for 0.99% fixed for the first 3 years became the headline. Advertised in bold type at model homes from Elk Grove to many. Cashback at closing, free stainless appliances, upgraded flooring, and even a year's worth of HOA dues paid up front. These sweeteners weren't just perks, they were lifelines for moving unsold inventory. One Inland Empire buyer described getting $15,000 back at closing on top of a below-market rate, just for using the builder's preferred lender. The catch: none of it appears in public sale records. For sellers like the TR family, these hidden discounts cut deep. Appraisers working off recorded sale prices see the builder's homes closing at full list. But the real price is thousands lower once incentives are factored in. That drags down comps for every resale in the neighborhood. Agents vent on private forums about the uneven playing field. While resale sellers shell out for repairs or staging, builders quietly undercut them with packages buyers can't resist. Leonard, Dr. Horton, and KB Home all ramped up incentives in spring 2025 with internal reports showing over 60% of new home closings involved some form of unpublished concession. The result: resale listings linger, even with price cuts, while buyers chase new construction deals that look better on paper and feel better in the monthly payment. The incentive arms race distorts the market surface, leaving traditional sellers at a disadvantage they never agreed to. Blackstone's Invitation Homes, once a fixture in California's hottest suburbs, quietly stopped buying here by the end of 2023. Internal strategy memos cited mounting headaches, rising insurance costs, stricter rent caps, and a rental yield that no longer justified the price. The official announcement to investors landed in December. All new acquisitions in California on hold. By spring 2024, deed records showed fewer than 100 California purchases for the year, a collapse from the 1,000 snapped up annually during the pandemic surge. In 2025, not a single Invitation Homes buy closed in the state. The money didn't disappear. It rerouted to Texas and Florida, where Blackstone's annual purchases topped 2,700 in each state, more than 5 times the California tally. SEC filings and analyst breakdowns put the capital shift at nearly $2 billion over 2 years, a fire hose of investment redirected to Sunbelt metros, promising better returns and fewer regulatory hurdles. The effect in California was immediate, but uneven. The investor pullback left a vacuum in the mid-tier and rental-ready segments where institutional bids had once set the floor for pricing. Without that bulk demand, homes lingered longer, especially in neighborhoods built for rental cash flow. Local sellers, already squeezed by slow-moving listings, lost another class of buyers almost overnight. Real estate analysts caution against pinning the entire inventory glut on Blackstone's retreat. Most of the flood comes from regular owners unable or unwilling to sell at a loss. But the investor exit stripped away a key safety net, amplifying the pain for sellers stuck with aging listings. Meanwhile, Sunbelt cities like Dallas and Tampa saw a surge of investor money chasing new construction and rental portfolios, fueling debates over whether California's pain is now another state's gain. By mid-2025, California's housing inventory is up 25% in the mid to high price tiers, reversing a decade-long shortage documented in state and MLS records. This glut is the direct result of zoning restrictions and permit caps from 2015 to 2020, as confirmed by city council transcripts and planning reports, which prioritize single-family homes over multifamily options. Buyers now hold more bargaining power, with mortgage rates at 6.8% to 8% and sales volumes down 20% from pre-pandemic levels. At the same time, many sellers like the Riverside family, who cut their price by $20,000 after 90 days, face mounting financial pressure as listings stagnate. Builder incentives and the withdrawal of institutional investors documented in sales brochures and acquisition data have further tilted the market against individual sellers. Yet the full impact of ongoing NIMBY resistance and future state policies remains uncertain. What is clear from the evidence? Past decisions have shaped a market where buyers have more choice, but sellers face new and persistent risks.